Thank you very much for the introduction, Andrew, and good afternoon. Oops. Okay. Yeah, when investing in a cyclical market like shipping equities, it's it's always important to look at the macroeconomic environment, and looks a bit troublesome, I have to say. So the Western economies are certainly sluggish. We have the euro area in contraction. So if you're looking at Hello? When looking at purchasing manager indices, they're below the threshold of 50, indicating contractionary area, and the US purchasing manager indices, the composite index is at a level of 50, meaning that the US economy is at the brink of recession. So global GDP is expected to grow by 3% this year. So it's a headwind also to the shipping industry. Now, the previous panel has talked a little bit about Chinese property investments. So the Chinese property investment is falling by nearly 9% year on year. So that's a headwind, obviously. So China is at risk to run into a debt deflation spiral. Now, it's not all that bleak. The Indian economy is very resilient, with growth rates north of 6%. And also the Japanese economy is showing strong exports at the back of a weaker yen. So all in all, it's from the macroeconomic perspective, it's a challenging environment from our point of view. Shipping equities have generated significant returns in the last 3 years. So it's a market you certainly wanted to be exposed in. Looking at the past year, 2022, we have seen, especially the tanker markets, extremely strong. Crude tanker segment up by nearly 80%. It's interesting to look at the scale that we have on the left-hand side. The product tanker, chemical tankers up by more than 150%. LNG up by 75%. We had weakness in the dry bulk segment. Last year, especially we had container stocks down, given that container freight rates have dropped by 65%. Now, during this year, it's the yellow-green bars that we are seeing. We're seeing container shipping equities flat, liner operators negative, whereas container operators are still positive. So the only segment within shipping which is a negative territory is the dry bulk segment, given the low dry bulk freight rates in 2023. But again, after a very strong year 2022, we are seeing the crude segments, crude tankers up 25%, product tankers up, and we've seen a stunning return with LPG shares with freight rates more than $100,000. Right now we're at $150,000 spot rates. So past returns have been very strong. When we are looking at shipping equities, a value segment, interesting for value style investors, we have to look at the metric, price to NAV metric, and we also have to look at the development of asset prices. And now those are second-hand asset prices, and we're seeing that tankers are up by 65%, and we're seeing dry bulk, 5-year-old tonnage up by 50% in the last 3 years, so that's quite significant. Can it hold up by this much? Can also look at new building prices. New building prices have also seen an uptrend in the last 3 years, 40% up for oil tankers and dry bulk carriers, 50%. And given, it was well mentioned in the previous panel, given the limited yard capacities that we are seeing, we are also expecting that both new building prices and second prices are holding up. So from that side, we are not seeing any headwinds, but still asset prices have increased quite significantly. So how are shipping stocks valued in the present environment? We're seeing the market not so cheap anymore. So tankers priced at a price to NAV of 0.9, so 10% discount to NAV. The dry bulk segment being cheaper with a 30% discount to NAV, and the LPG segment also, given the strong freight rate environment, priced with a discount to NAV of 10%, so 0.9. So I would say not expensive, not cheap anymore, but moderately priced. When we are looking at the order book situation, and that I can tell, that I could also mention at this point, we are now focusing in our equity strategies on those segments that have low order books, where we are seeing limited supply in the medium term in the years to come. So bulk carriers at 7.9%, crude tankers 3.9%, product tankers still at around 8%, but we are careful in the segments of container ships, which are up 26%, and LPG has been extremely strong, but the order book is also up quite a bit. So those are the segments that we prefer. It's the crude tanker segment with a limited order book, and when we are considering that peak oil demand is yet to come, 2024 estimates of the International Energy Agency is 105 million barrels a day for oil demand. Then, in this case, supply appears quite tight in the segment, and also given the fact that the fleet is already quite old, it's a segment that we like a lot. Same accounts for the product tanker segment, where also the fleet is still quite old. LR2s, 22% of the fleet is older than 15 years. So from that perspective, the order book looks quite favorable. So we believe that also in 2024, we are seeing quite a good freight rate environment for the two segments above. Offshore supply is another segment that we prefer in our strategy. The order books are just at 2.5%, so very low, and we are seeing very tight capacities as also banks have really pulled back from financing in this type of segment. Capacity utilization is going up, so we are at around 80% here, and also the charter rates are moving up quite nicely, so expectations for the year 2024 are quite nice, so we think it's going to be a good environment for offshore supply. The dry bulk segment is the most discounted, as we have mentioned, at 70% of NAV, so 30% discount. We think that there's a floor on the market right now. Freight rates are moving up also, but tanker operators prefer, well, we're seeing now dry bulk operators buying back shares at a discount to NAV. In the last week, we have seen star bulk carriers buying back shares at $18.50 per share rather than ordering new ships. And this type of situation that we are so much discounted to the NAV is giving us a comfort level building up positions in the dry bulk segment. Certainly, we have discussed it before, the macroeconomic perspective is clearly challenging, so we could see headwinds there in the cyclical segments, but still, fundamentally, the dry bulk segment looks attractive. In the container segment, we are very careful. We have some exposure on the fixed income side, but not on the equity side, as order books are quite high from what we believe, and still, also the demand side has been quite weak during 2023. LPG is a segment where certain stocks are already trading above NAV, since we now have freight rates of more than $100,000 a day, up to $150,000 a day, much stronger than expected the market in 2023. So from that perspective, this market has run a bit hot, and we prefer to abstain. Car carriers is extremely strong. We're seeing very high freight rates. We had the panel before, and this is expected to persist. But medium term, the order book, which is at 27%, could weigh on the market from our perspective. So this is our outlook for the sub-segments in shipping, and it gives also certain indication of how we are moving on with our investment strategy. That's it from my side. Not sure if there are any questions from the audience.